Hello. We've talked about indexes, and I mentioned that they aren't actually assets. You can't trade on indexes since they're simply measurements of a market or economic activity. We did say that you can invest in derivatives or ETFs that follow these indexes. Well, now it's time to talk about those ETFs, exchange-traded funds. And that's precisely what they are. Funds are assets that are usually created by a stock exchange or an investment firm. Mostly, they're pooled investments, and they're usually managed by whoever created them. Like mutual funds, ETFs incorporate a portfolio of assets, usually belonging to a specific sector. In that, they also resemble an index. Unlike an index, however, they are offered on and then traded within an exchange. You can invest in an ETF just as you would in a share, and you can trade them throughout the day. An actively managed ETF must be fully transparent, and its portfolio makeup must be updated and published daily. Therefore, it's wise to trade on ETFs with a broker who is active in all the markets that an ETF covers. Some ETFs track a nation's stock exchange, like the Canadian MSCI, which owns shares in banks, energy companies, railways, and insurance firms. Others will cover a sector. SPDR covers the energy sector and owns shares in Exxon, Halliburton, and others. And some cover market performance factors like the Velocity Shares Daily Inverse VIX Short Term, which is actually an exchange-traded note. You see, these resemble bonds rather than shares. The one simply tracks the Chicago Board short-term VIX futures. They measure market volatility. All in all, ETFs, like indexes, are excellent hedging instruments since they react to the assets they track. They're more stable, and they're great for long-term investments.